So as we were discussing before about that recent investment you guys did in like 24.5 crore in Greater Noida, and there's a partnership with SWAMIH Fund with that. What went behind in selecting that particular project? And tell us about this partnership. How does it fit in your strategy? And what did you come up with the kind of filter you have as we spoke about? What factors made you attracted to this project?
It's a very interesting investment, Kritika, and the first for us, honestly, of this nature.
Mm.
In 2021, when Swami was instituted as a federal fund backed by the Ministry of Finance, its objective was very clear that it needed to capitalize and help projects so that the home buyers which were stuck because of capital issues could actually see the delivery of their homes.
Yeah.
Now, that's a very powerful objective because the sole intent of this fund is to ensure that the project completes in the fastest period of time and people get possession. When you look at that scenario, and if you were to invest, for example, with Swami or in Swami or any other format, you know for certain that the project will complete.
Yeah.
Now, when a project is complete, there is significant value that is got unlocked. Whatever people have bought will get their homes, they'll pay their balance money, and there will be ready inventory even if it is not sold. Now, that has a certain ascribable value because it's an OC ready inventory in a market that is good.
Mm.
So that's the first thing we saw is that the outcomes are absolutely finite and determinable.
Mm.
So all if he did was ride with Swami,
Mm.
then we know that the project will get delivered. There will be a certain value which will get unlocked, which is available to people, to all stakeholders. So let's take a percentage of that value for ourselves. So the challenge, and of course, as part of the mandate, and rightfully so, Swami cannot take out an erstwhile lender. They cannot discharge a loan. They cannot refinance somebody.
Yeah.
Their objective is simply to put money into completing the project alone and ensuring it using all mechanisms and checks and balances that happens within an ascribed time frame. So the problem statement, therefore, is that who takes over the existing lender? Because unless the existing lender is discharged, that project is not free to take new capital.
Yeah.
So that's really when we started deliberating that how do we partner?
Mm.
So we then came up with this formula that, okay, if there's enough value, then it makes sense for both of us, right? Because there's enough surplus. That's the first thing.
Yeah.
Second, which micro markets work for us? Of course, Swami's objective is pan India. Our objective is not pan India. Our objective is key micro locations in key mega cities or metropolis locations, and NCR is one of them. It's NCR, MMR, Bangalore, Chennai, Hyderabad, because these are large consumer, very large consumer bases. Which is why we see millions of square feet being developed and delivered by some of the largest names in the country in these micro markets. So we said, well, this is a large consumer economy, large consumer real estate market, and the purchases there are all by mid-income affordable guys who are stuck to receive their first home. So again, as I said, it's discovery of intent. Is the intent right? Was it right? And if it is right, then what is the solution? And where is the problem lie? The problem obviously lies because maybe a lender is not able to support a project, or there has been a capital mismatch with an existing lender, which obviously we've seen that it had gone to insolvency. It has now got resolved. Somebody else has taken it over, and they're more than happy to resolve this asset. So now that solution with that lender is available. Now, if that solution is available, then we're happy to actually be the solution to that problem, where we can take over the loan and we say, okay, now Swami can put in 4 times the amount of money that we've invested to exit the lender to actually complete that project. So the surplus that is generated is available to us. So I'm certain of my outcome irrespective. Now it's a question of time. Will I get my surplus in 2 years or 3 years or 3.5 years? But even if I got it in 3.5 years, the surplus is large enough to cover my capital multiple times. So my capital is secure because Swami as a federal fund is delivering its objectives and very stringently. So I think that's a beautiful solution. And I'm actually quite proud and amazed that nobody else is doing it. And we've actually found this partnership. Because there's no better safety in actually investing in a completed asset. So that was the first part. Second is how can we ensure that we still see some liquidities? And then there are formulas. Is there a surplus asset that we can monetize and we can get in our favor, which is not forming part of the project? Can we have some cash flow sharing during the term of the investment because there's enough cover? So even if there is a top line sharing in our favor as co-lenders, then obviously that services our capital as well. So then those are fine tuning issues.
Yeah.
But fundamentally, I thought that because it's a cheaper capital, therefore, even if our capital is expensive, the blended cost doesn't hurt the developer who anyway was borrowing cheaply or at the right market price in the past. So as a blended cost, it is actually quite affordable. It does not impair the margins of the project. Second, as I said, because the dictator Swami also is very, very aligned with the way we look at things. There must be high skin in the game, which means there must be enough promoter equity. If not, they'll ask them to put more equity. There must be no issues with regards to approvals. All approvals need to be in place. So they're not getting stuck because approvals are not going to come. Because the objective remains we need to deliver and complete and get OC within a finite period of time. Third, there are no disruptions with regards to RERA cases or consumerism, or the whole matter is headed towards NCLT or insolvency. So all those issues are not there, and the people are aligned, the stakeholders are aligned. So a lot of the check boxes for Swami was exactly similar to what we were wanting or what we were doing. So there was a natural alignment because of that. That what they want and what we want is same. Which means the kind of projects I will lend to and what they will lend to is same or similar. So therefore it creates better partnership, because then because of the cost of their capital, because of their ability to actually provide extraordinary amount of money to ensure the project gets completed, I don't have to worry about the end game in those projects. So that made it very easy for us. So which effectively we're just riding along. So they're the big wave which is going to all carry us ashore without a doubt, because it's a big ship, and that big ship is a sovereign ship. So it's all monitored by by the federal government and by the ministry. So I think that's a very, very strong partnership to have, and I think that really made a big difference. That if you're going into NCR, into a project where a lot of people have had problems in NCR, but because this is backed by Swami, and we've seen outcomes. They've invested in a few other projects in that micro market or in that vicinity, and we've seen the outcomes of those projects. Phenomenal. The projects are getting delivered, the prices have gone up, people are more than happy to pay. Balance sale has actually shot up because everybody knows now it's a Swami funded project. So it's seen those examples in that same vicinity. So this couldn't have been any different. So that really inspired a lot of confidence, saying, okay, why don't we go and do this? And that partnership is now continuing. We're doing more such investments where we're taking out the lender, we're partnering with them, and we're figuring out, or we have formulated ways so that we also get paid while they're getting paid. So that we're not waiting for necessarily 3, 4, 5 years. We're also seeing our liquidity, and they're seeing their liquidity.
Also, your recent investment in the Trescon Group plotted development, I wanted to understand what potential growth did you see for this particular project, and do you see any potential growth happening in tier 2 cities or non-metropolitan cities in India?
I was never certain about the outcome for tier 2 cities because the markets were smaller, and we always data point suggest that 80% of the sales actually happen in the 8 cities of India, right? And that's what, when you pick up a research report, you see these are the 8 cities, this is what they're performing, they form 70-80% of the market share. But when you start actually spending enough time and when you start seeing trends, a lot of cities are now emerging as top cities. So there's a lot of research out as to which are the 10 richest cities. And we need not be Mumbai, it'll be actually a Surat, it'll actually be in Indore, which are the cleanest cities, which are the fastest developing cities. So when you start studying the trends there, we realize that there is an extraordinary amount of change which has happened in the consumer behavior in tier 2. They're no longer necessarily wanting to stay in independent villas or bungalows or plots. They're happy to actually go into high rises and group housing, live like people live in Mumbai or Delhi or Bangalore. I think that's a big shift, especially with the Gen Z and the next gen. I think this whole nuclearization has also happened now in tier 2, tier 3 cities. It's not limited to metro locations alone, which means that people are looking, as families expand, at newer assets, at modern assets, at ability to build their own homes. And there's enough and more liquidity in these cities because for them, real estate is a prime investment asset class. Unlike in metro locations where we'll dabble with crypto, we'll dabble with venture debt, we'll dabble with so many other asset classes, we'll put in stock markets, and we'll be asset light. The tier 2, tier 3 mindset is still very asset heavy. I want to invest, I want to own, I want to have my own space. Now, that liquidity which has got generated and is
Hmm.
sitting in tier two, tier three is very large. So, when you start studying consumer trends, especially within FMCG companies,
Hmm.
then you start to think, what am I missing? If the largest sales for FMCG companies and online sellers is actually coming from tier two, tier three, there must be a lot of demand and liquidity. So when you start actually discovering that and going to some of the best cities, which are not necessarily the top eight cities, you actually start seeing these results. You start seeing data points. You start seeing projects. And that's really when we decided last year that we will actually now foray into tier two, but
Hmm.
slowly, because we need to have the same confidence, the same information, the same amount of engagement with these cities like we have with the top eight cities. Like we know them backwards, we must know them backwards. So
Hmm.
we started studying them, understanding Ahmedabad, understanding Indore, understanding Nagpur and Nasik, understanding several other cities, and figuring out what is it that we can do here because clearly the markets are super vibrant,
Yeah.
super vibrant. I
Hmm.
mean, product is selling at a far greater pace there than it is selling in metro locations. So we said, let's take this call that it's and again, it's again about being anti-system. It's about being creating a differentiation for our
Hmm.
investors and ourselves,
Hmm.
about stepping away from the crowd and not falling into that, into that race.
Hmm.
And that's really where this untapped potential lies. Because the top investors, the top lenders, the top funds will still continue to work these eight cities. So now today, as a domestic fund, has the opportunity to go into a different backyard and say, let's look at this. So
Yeah.
when you look at plotted development, again, it's a no-brainer business, especially in many parts of the country. When you look at South, when you look at North, when you look at even MP, plotted development sells like crazy because everybody wants to own a piece of land that they can eventually build and stay in.
Hmm.
And when you actually look at one of these largest colonizers in Indore, when you say, okay, these are people who actually set up the city, who've done, millions of square feet. And when you see a nice curated development, which all the necessary amenities that a new age buyer will want. You've
Hmm.
got a clubhouse. It's not just plotting and selling. You've got the clubhouse, you've got the amenities, you've got a nice gated community, you've got the landscaping. It creates a great aspirational demand.
Hmm.
It's not just an investment for the future generations to monetize. It actually is an aspirational asset now.
Hmm.
So I think that's really what drew us. And of course, there was enough track record of enough of these projects having been built, sold well. And so there's an extension of this demand which we're trying to fulfill. And
Yeah.
that made tremendous sense. So a very small amount of capital actually creates a multiplier effect in tier two cities.
Hmm.
Unlike in metro cities where you need too much capital because the land is so expensive, the
Yeah.
construction cost is so high, the selling price is even
True.
obnoxiously high. That's not the case,
Hmm.
right? So while the wealth levels or per capita income in tier
Hmm.
two is actually quite high, the consumer spend on real estate as a percentage of their net worth is actually much smaller.
Yeah.
In 5 crores, you can actually buy a lavish residential
Yeah.
apartment in any tier 2 city. You
Hmm.
will maybe afford barely a 2 BHK or 3 BHK in Mumbai.
Hmm.
You'll have a 7 BHK or a penthouse
True.
maybe in those cities. So it's amazing,
Hmm.
that what real estate can actually do and how it can be afforded. And that's a great story,
Hmm.
which people haven't really tapped. So I think that's really when we started to foray. We're taking these small steps.
Hmm.
We've now gone to Ahmedabad. We put about 100 crores to work there.
Hmm.
We've gone to Indore. We put 25 crores to work there. We're putting another 40, 50 crores to work in that city.
Hmm.
So as we start discovering these cities, we start understanding the consumer trends. And again, more importantly, I think it's about maturity. Earlier, because it was localized business with localized players and localized consumption,
Hmm.
the need for governance was very less. You could start a small project, you could sell it locally and do it on your terms.
True.
Today, as the market expands, it matures, and there's consolidation happening across the country, I don't think it's no longer a localized play for anybody.
Yeah.
I'm in Ahmedabad and I now see actually some of the largest developers talking about taking global capital, taking private equity,
Yeah.
something they would hate. They don't want somebody else sitting on the book. But today they understand and realize that the potential is so much larger. And the fact that they can actually consolidate the markets in their favor is so much larger that
Hmm.
unless they partner with blue blooded people, with institutions, with financial institutions and investors like us, they will not be able to capitalize on this opportunity by themselves, by local money, by local play, by local demand alone. They
Yeah.
will need that firepower. I think that is what is allowing these companies to transform. If,
Hmm.
where we've invested or where we are investing, they've already transformed. They're demonstrating they have the necessary governance, they have the necessary systems, they have the necessary people and resources and systems to be able to actually take institutional capital and do what is necessary to ensure that we have complete line of sight and understanding of every step that is happening into these projects.
So the recent report by Anrock indicated some positive trends when it came to luxury premium homes in MMR. And we saw a 13% increase in the unsold inventory of budget homes. So what would you foresee and what do you predict when it comes to MMR regions? Are we seeing luxury homes being investment more getting increased and the affordable homes going to go out of the market? Especially are we when we are talking about the MMR region?
I don't think affordable housing can ever go out of flavor. It is a very core product, and not very many people in our city can actually invest more than 70, 80 lakhs or a crore of rupees to buy an apartment.
Mm.
And there's only so much travel that you will do in a day to go to home and office and back, right? So I think that demand is prevalent. Obviously, because of various reasons. One, of course, being the large creation of wealth post lockdown, with the stock markets, having rebounded in a very large way. A
Mm.
lot of new capital inflows, a lot of M&A, a lot of buyouts. There's a lot of liquidity that got created in the hands of very many people, especially within the IT sector, within the stock markets, and within several other people who were exiting their businesses at a profit,
Mm.
that their ability to actually buy these assets, especially obviously the realization that I need a comfortable dwelling which can sustain me during another such black swan event, was anyway a prevalent force across the country. So that obviously, tilted consumer behavior in favor of larger areas and more luxury dwellings. But it was also to a large extent determined by the whole taxation fact, which obviously has got plugged in this last budget,
Mm.
where capital gains are now limited to a quantum of 10 crores, right? So any purchase above that will be subject to maximum taxation rates, and there's no capital gains benefit beyond that.
Mm.
So because of the capital gains issue as well, that was one of the bigger driving forces, which is why, and Mumbai being the capital of financial services and the generation of capital gains has possibly been the highest in the city. That's really where a lot of purchases happen in that segment, driven by both these needs: a to get into better spaces, and of course to also get the dual incentive of tax benefits. Now, with that gone, I think the market will normalize. See, because the luxury segment still is about 3-4% of the market, and
Mm.
there are only so many people who can buy that. So, anybody who believes that this trend will continue and that larger luxury homes will continue to get sold in perpetuity, I think is going to be in trouble, because we've seen this enough times in the past. We
Mm.
saw that in 2009, and also right after the GFC, everybody said only luxury will sell, and then suddenly luxury stopped.
Yeah.
15, 16, everybody went back to affordable housing.
Mm.
But affordable housing guys have never had a problem.
Mm.
Luxury guys have had a problem. We've seen stuck luxury projects for years.
Mm.
We've not seen so many stuck, especially in MMR or in core locations. Let's say in Bangalore, where affordable housing projects have got stuck. People do end up completing it, selling it, and getting out very, very quickly because the demand is very high. That's the bulk of the demand is the MIG segment. So I don't think there's any problem that. Yes, the configurations may look slightly different. So today a studio may not work. You know,
Yeah.
you may want a 1 BHK
Mm.
or 1.5 BHK, so that you have enough space, because still we have hybrid working systems. So not everybody needs to go to office every day still, and so therefore a little space so that people can have their own sort of den to work out of.
Mm.
Have their own privacy, have their own distancing. I think that continues to be a dominant driver. That you don't need to be in cramped spaces. If you can actually put out a little more capital, you can save a little more. You can ensure that safety net for yourself. And I think this whole 2 years of lockdown has really created an indelible mark on
Mm.
consumer behavior, that we cannot stay in cramped spaces. If we can afford it, or if we have the potential maybe to afford it, let's try and make that extra effort to actually, get into a larger space. So I think that remains. But having said that, doesn't mean affordable is out. I am a very strong proponent. It will come back. Of course, it's also driven by interest rates.
Yeah.
Today, when the mortgage rates are at 8 and 9 and 10%, it's very hard for somebody who's already buying an expensive apartment to also pay very large EMIs. So I think it's driven by interest in a very large way. So
Mm.
once there's a reversal of the interest cycle, and it has to happen, at some point in time, I think we'll see the emergence in a very strong way of mid-income affordable housing come back. See, because today those who are agnostic about interest rates are going to buy. I don't mind paying 10% or I can pay on my own capital. I'm a
Mm.
self-funded buyer. So that's the segment which is obviously very prevalent. They're insensitive to interest rates. But the larger population is obviously very sensitive.
Yeah.
Every 1% can actually cause a significant impact on the net savings available to the consumer. And that's something which is obviously going to drive home buyers, away from the market till such time the interest rates come back.
Mm.
Also, one of the bigger concerns as to why there's been a dip in affordable housing is also because some of the incentives which are available under PMAY and some of the other
Yeah.
affordable housing schemes have gone away. Where I could get a discount, I could get a rebate, I could get subvention schemes, I could get discounted home rates. All that is gone, which
Mm.
means now I really need to be able to afford it myself. So while people are building up that strength and that
Mm.
demand remains, I think once the interest rates soften, I think that will certainly come back in a very big.
So we have noticed, and I'm sure you must have noticed because you've been in this real estate domain for so long, the finance investment evolution has been changing. Now we are seeing fractional ownership also coming in. What is your take? Share the journey that has gone from start till now, and what is your take? What future are we seeing when it comes to investment in India, especially for Indian real estate?
It's a very interesting time because there was a Crystal report which talked about the financialization of India Inc. As to how people are getting into digitization and
Yeah.
financialization of assets. So from a hard asset strategy, which was really the dominant strategy forever, to the last 5 years, where with the advent of UPI, digital payment systems, uh, real-time transactions, the number of demat accounts which have got opened thanks to very very beautiful startups, the whole engagement with virtual assets or digital assets for investors as a whole across the country has got deeply percolated. So from owning, feeling, holding to understanding that there's something available in a digital format. I think that transformation obviously has now become permanent. So clearly, that is causing products like tokenization or fractionalization to start becoming prevalent in the country because people think that they understand that it's okay to own something digitally or fractionally and not necessarily be a title holder and a physical holder of that asset today. I think that entire transformation has obviously helped this asset class. And I'm seeing more of that. I think people are going to continue to move away from owning and managing physical real estate to actually looking at it as a investment virtual asset class. And of course, whether it's AI, whether it's some of the crypto related investments in real estate to meta spaces, I think that's really also going to continue to become prevalent over time. Today, of course, we don't have meta spaces in India as much as we've seen in other markets where people have actually traded meta spaces, and it became a tradable asset class. Fortunately, we're not dabbling into that sort of casino. But I do believe that people have the propensity today, A, with growing per capita income and larger saving potential, their ability to actually take risk and discover new products, invest into new age solutions and investment asset classes will continue to grow. And the Gen X and now the Gen X is transforming and more now the Gen Z and the Gen Next. I think they're becoming more pro, going digital, take consuming digital investments, being part of this whole digital journey. So I do see that that whole acceleration in favor of REITs, in favor of AIFs, in favor of token products or tokenized products. Without a doubt, I think this whole holding to physical assets is something which will become more passe and it will be more collective investment so that like in mutual funds and which is how mutual funds grew. I mean, earlier people used to hold their own physical stocks, then eventually everybody went to mutual funds. So I do see this collective behavior which is more risk averse, which is more collectively involved in actually balancing out opportunities and risks becoming more prevalent over time, and which is why the opportunity is so great in favor of managers like ourselves who are able to actually curate these opportunities, put it together, manage it, and collectively provide that opportunity to a wider audience as opposed to one person taking that entire risk and managing by themselves. So I think that, and people again have enough new things happening in their lives to be able to dedicate full time their time and their effort and their energies and lives towards actually managing, owning, and maintaining assets. Our grandfathers did that. Maybe our fathers did that. I don't think we want to do it. We don't want to be able to every weekend going and looking whether our tenants are okay, going and collecting rents, worrying about whether faucets are broken in that tenanted apartment, or whether the tenant is complaining about why the rent should not be paid. I think people want to get away from all of that. They want it to be simpler. They want to be able to do more with their time and lives. So I think that's clearly happening. In terms of, but what's also interesting is that the regulation needs to really catch up. True. Because the transformation and digitization is so fast that unless it is well regulated, it leaves a very large risk of failure and governance in the hands of investors. We've seen that with crypto. We've seen that with a lot of new age assets. Now today, the whole idea of tokenization and fractionalization is under SEBI's scanner, where they're saying, can it become a MSME REIT? So that anybody who's investing is actually governed, protected, and there is a certain common framework available to anybody who's dabbling in this space. So it's not anybody's fancy or marketing skill alone. It is very fundamental and is measured by the same yardstick. So I think that's very important. And I'm a very big believer of regulations. I think it's important that while technology is a disruptor and then digitization can create faster, more efficient solutions, but it's even more important to understand that regulations are equally important because, especially in our country where people can run amok, where ideas can be greater than the fundamentals, I think it's important that the regulator steps in and keeps those fundamentals intact for the benefit of consumers and investors. So I've never ventured into fractionalization or tokenization for the simple idea that it's not regulated. And if it's not regulated, I cannot offer you a yardstick which does not make sense to everybody. So now that it's likely to get regulated, it becomes an interesting avenue for all of us.
So I'm curious to know, and I completely agree with you, regulation is very important, especially when we are seeing in the global market what's happening with the politics, what's happening with the economy. Be the example of China, the Evergrande, how it went along with how it impacted not just the real estate market, but the economy of the country. What do you say when it comes to such events happening around in India? How is it going to affect our investment, especially when it comes to the AIF funds? Do you guys consider these setbacks which is happening globally, or do you think it's not going to affect Indian market and we should continue how it's going with the AI fund?
I think it would be foolish to say that we are completely insulated from global shocks. Um, while we are a consumption economy, we're very highly dependent on domestic consumer behavior to propel our GDP. Even if we did no great exports, because of consumption alone, our GDP would grow at 4% plus annually. And I think that's a very, very large driver in favor of our economy. But it's important to understand the lessons that one learns from global shocks and events like these. So, first, too much leverage is a problem. And we've seen that as one of the largest causes of failure for even not just global companies, but very large Indian companies also. They were unable to withstand the effect of over leverage when markets went down. So I think it's very important to keep the discipline as to what is optimal leverage levels and what is it that the borrower is able to do to ensure that the leverage is able to be serviced and in a very comfortable way, even in extreme downturns at all times. So I think that discipline is very important. And I think people have realized that. But unfortunately, the memory of the markets remains very small. So I remember in 2008, because of the GFC, everybody talked about deleveragation and let's delever our balance sheets. When 2011-12 money became cheaper, we said relever balance sheets. Again, after the Black Swan event, everything again delever balance sheets and let's look at equity. So I think these cycles keep on having. But the fundamental that it must be an acceptable and a manageable level of debt is very important. Second is also understanding whether the construction or development is speculative or is actually catering to a fundamental demand. Like in a lot of ways, I think luxury housing is now being built on speculative demand because people have seen success in a few quarters and some of the bad decisions of creating very large houses were forgiven because people actually ended up consuming them or buying them. Made people or makes people believe that there's more that can be done. But remember, that was a very small inventory, which got taken up. If you're doing 5 times or 10 times as much, the chances that you're going to get stuck again is very high because the consumer base, while it's growing, is not large enough. Right. So I think it has to be very fundamental and very rooted in what actually consumers want as opposed to your own dream of what people, what people should buy or can buy, because there's no data points to that. So I think that's one of the important aspects, and that is why we've seen the problems in larger economies, where to keep up to a certain momentum, especially for listed companies, I think that becomes a challenge. That when you're very large and you need to keep up to a certain momentum or expectations of both equity holders as well as debt holders, you need to continue to build. And when you continue to build, you're then starting to build speculatively. And we've seen a lot of ghost towns and ghost cities in China. We've seen stories about how horrific stories about completely empty cities which have left standing, which are now being demolished. So that is the problem or the bane of large listed companies which have got too much capital and too much leverage, that they need to show performance. Fortunately, we're not at that level yet, but I would caution people who are growing fast to be aware of these issues. And it's okay to say, I don't think there's an opportunity. The results are going to be flat. The sales are going to be flat. Maybe shareholders will not like it for 1 or 2 quarters, but they'll appreciate the fact that you preserve value. So the need for quarter on quarter earnings growth in real estate, I think, is untenable, unsustainable. There must be rationality. It's not a FMCG company where it can come up with new products and new markets and penetrate. There's a limitation to real estate. It's still a job shop. And I think once we understand that, and listed companies understand that, I think we won't have those issues in India like we've seen in other economies.
So technology has been important and it's been integral in all the industries, especially in even finance and real estate industry. Digital transformation is happening. What kind of tools or what kind of technology are you guys implementing in Nisus Finance to make sure the operations are seamless, to make sure, as you quoted earlier, you go through the data analytics and market intelligence to do the filtration of the projects? What other tools do you guys implement?
So it's important now today for our LPs, our investors, as well as our investing companies to know what's happening on a real time basis.
Yeah.
Which basically means that there are enough tools available for real time monitoring, both on site and off site. Were plugged in into cloud computing, which means all data goes to the cloud, and we are able to actually pick up data immediately on real time basis, whether it's CRM, whether it's tally data, whether it's actual progress on sites, actual data sheets from sites on a daily basis. This is all today all based on cloud computing and cloud analytics. Second is that today we have got web-based solutions and accessibility available to LP so that they can access the same data in a far more sophisticated and curated way at the click of a button. Earlier, investors had to wait for NAV statements and annual reports from funds to understand what's going on and understand whether they're actually in the money or not in the money. Today, they can do that on a real-time basis, on a daily, weekly, quarterly, as and when they want to access that data. They can understand their NAV. So there's auto computation, there's auto valuations, there's auto reporting, there's auto data sheets getting created. So a lot of the data is actually getting pulled real time and is getting computed and getting delivered to our investors. That allows us to also be sharp about what is it that is going wrong on a regular basis. So I think from a manager standpoint, because it's not a listed asset class, so you really don't have daily trade data. What is relevant is the variables and the fundamentals of the operating numbers of the investment. When you're able to collate that, when you're able to analyze that every day, when you're able to put that into a discernible format, and you're able to actually then create variances as to whether it's on track or out of track, actually that gives a lot of intelligence to the investor as to whether they're in the money or likely to be not on the money. So I think that's really where it's happening. Again, one is getting live 24/7 data feeds from the sites. Everybody's into surveillance and monitoring. There's a lot of systems now in place to ensure that there's no pilferage at the site. So a lot of these technological interventions have really helped control the asset as well as report things on a regular basis, which is what we're able to pass on to our LPs.
So the projects where you put the working capital, now there are a lot of property companies where the BIM, building information management, when the slab is being put, what kind of concrete is going in, and everything, all those information is also put in the real time so that the developer, even the consumer, can understand what is the progress of the project. Are these kind of tools you guys also looking into?
No, absolutely. See, again, BIM is relevant for a very large project. So if it's a large project, we certainly insist that BIM systems must be in place. Otherwise, the PMCs that we appoint actually have a fairly robust charting system by which they're able to monitor each of the variables. Because remember that these are already projects which have seen a significant life cycle.
Mm.
and therefore most of these variables are fixed. So we know exactly how much materials need to go to complete and of what quantity and at what period of time. So these are already variables which have been prefixed and determined. So when a PMC is appointed on site, that's exactly what they're monitoring is the variances and the consumption. It could be on a BIM system if it's a large project, or it could be a simple charting system, which most PMC companies have. But that's clearly a very important aspect is for us to actually receive real-time data on the site.
So how do you predict the technology will be in future in real estate when it comes to finance and investment in real estate?
So I think technology is applicable across different spheres of real estate. I think first starting from the surveying itself.
Yeah.
A lot of the surveying was done, manually and physically by each one of us. Today, there's a lot of drone-led surveying that is possible to understand the micro market around the vicinity of the projects, to understand, how the landscape and the topography looks around the particular investment. So there's a lot of drone-level surveying that happening, which helps us get better understanding and intelligence about comparables, about the impact areas that we're dealing with. The next thing then really goes into how we can digitally due diligence and do real time data rooms for us to extract data and information. Fortunately, a lot of the title information is gone digital. When you're looking at land titles, a
Yeah.
lot of the information is already digitized. So that helps us create very quick virtual data rooms where all the agencies can actually feed off the same data. Earlier, there used to be a lot of time spent in actually collecting the same set of documents by multiple agencies. Today, that time has got compressed, and everybody's getting the same authentic data as everybody else has got. So, can be no discrepancy in terms of what is being offered to multiple parties. So that creates more authenticity in terms of due diligence and documentation. When it comes to monitoring, as I said, there is obviously now technology in place where we're able to monitor it real time, whether it's through BIM, whether it's through CRM systems, whether it's through accounting, so what Tally systems, whether it's actually the feed cams available on site, which actually show images on a real time basis as to what's happening on site, and there's surveillance which is going on a real time basis. So there's a lot of that. And then finally it comes to cloud computing and analytics, which obviously determine how we're able to report. Now, in terms of time and cost, it compresses all of that. B is, of course, there's always an endeavor to see how do we be more ESG compliant, be more environmentally sensitive,
Yeah.
and how can technology help that so that there's less pollution, there's less energy consumption, and we're looking at more greener buildings.
Yeah.
That's very important for us, as that what we're producing is actually, what supporting is actually ESG compliant. And second, how can technological intervention available in any part of the world be used to reduce the carbon footprint, compress the cost and the time that is taken to complete the building? So whenever we get in, we certainly analyze, are you doing a conventional method? Are you doing a shutter form method? Are you doing tunnel form method? What method of construction are you using? How you want to compress the time? How you going to ensure that the time available to actually pollute and construct is reduced significantly and bringing down the emissions and pollution levels in the project. So I think that's very important, and that's really where technology plays a fairly significant part, which is where we mandate the PMC to say, okay, now let's get this done. So our technical teams, the borrower's technical teams, and the PMC, they spend a lot of time pre-investment to actually set out the targets as to how things will progress. So if we need to change the technology, we'll ask them to change the technology so that they can do faster, more efficiently, and at lesser cost and time. It's
Interesting you mentioned about sustainability in this. So sustainability and eco-friendly practices are being very implemented in current real estate. It's not become the modern lingo or just a lingo to go by. So in Nisus Finance, are you guys also considering those kind of projects which are actually looking into sustainability, eco-friendly practices also?
So we've been doing this for quite some time, even before it became the buzzword or the word to talk about, with the COP28 or the G20 or whatever other sustainable norms that our country is putting out for itself and for its peers. We've always looked at ESG as one of the key deliverables for ourselves over the last 7, 8 years. We realized that the more efficient, more sustainable, the more green, the more ESG compliant we are, the better outcomes we've seen in our investment company. We've seen better traction with local communities. We've seen better engagement with the consumer. We've seen better appreciation for the asset that is getting created, even if it means that there must be a certain margin erosion for the producer. And sometimes it does come with a little bit of a regressive thought process that do I really need to spend a little more to get a little more?
Yeah.
or should I go with conventional assets? And I think our intervention, therefore, has always been, Kritika, more than capital. If I have to say that we're a bank, would be wrong because, or a pure financial institution would be wrong because our engagement is actually as an investor, as a partner,
Hmm.
wherein we have to understand what is it that we are backing, where are we putting our name to it, is it going to create a product or an asset or an icon that will be remembered for something that it did differently? Just like we create different products and solutions, we want our investing companies to also behave in that fashion. Create
Definitely.
something different, be more sustainable, be more responsible, be
Hmm.
more accountable. What sort of social impact programs are you going to run for people who are working in and around the projects?
Hmm.
What are you going to do to ensure that there is transparency and safety for all people involved?
Hmm.
What welfare programs are we going to run?
Hmm.
So I think these are very important soft tools that are employed in pre-investment, and we ensure that we try and run them to the best possible way and
Hmm.
they're ESG compliant. So, including, for example, if you're doing bricks, are we doing hollow bricks? Can we ensure that we have enough supply of hollow bricks on fly ash bricks so that we're not using enough
Hmm.
and more concrete on site? Can we ensure that there's less transportation involved and do more RMC batching plants on site which are more efficient and green? So I think there's a lot of endeavor that we actually get in to ensure that, and I'm very, very passionate about it. So if the project does not meet the check boxes, so maybe the corporation doesn't need you to have a double piping system where you can recycle wastewater. But if you don't have that, I'm not interested in your project, even if it's going to make money, because it's not
Hmm.
sustainable. You need to be able to use wastewater.
Yeah.
You're not going to be able to just put it in the sewage. I need you to have an STP. I need you to have a water treatment plant. I need you to find out solutions that you can have solar paneling so that you can reduce energy consumption. These are very critical items for us. See, because again, our objectives are not to put out billions of dollars to work again, Kritika. It's
Hmm.
about creating meaningful impact for everybody,
True.
for ourselves, for the investors, for the project, for the consumers, and for the society as a whole. And if you're not able to do that, then we're not creating an equitable solution with our capital.
It's quite interesting to know because if it would be a bank or developer, they will say putting these kind of efforts or initiatives is expensive in the books,
I know.
right? It's not like profit making, and it's good to know that Nisus Finance has been doing this for a pretty long time.
Yes. We're very proud of that, and we're happy that, especially in today's age, with the newer generation taking up
Mm.
reins of development companies, I think they are eco-sensitive and their social consciousness is far greater. They're not just driven by profits; they're driven by contribution. They're driven by their impact as individuals and as a company. They're looking at making a statement about who they are and what they do in the society. And ESG is becoming a big part. So I think today there's a far greater maturity, far greater understanding, and far greater recognition of
Yeah.
larger companies' responsibilities and their impact on their environment than it ever was before. Because fortunately, in today's market, people are not so much worried about profits or turnover.
Mm.
They're worried about sustainability. They're worried about image. They're worried about recall. They're worried about brand valuation.
Yeah.
And to build all of that, I think it's very critical that each one of them does exactly that. And which is why they're accepting it. And when we have seen REITs, and I think that was a very great turning point when grade A assets were REITed out and global investors participated. And that message went out in a very large way to the development community that if you're building a great asset,
Mm.
which is sustainable, which is green, which fits the criteria of global occupiers, you will get global capital and you'll be able to sell at even 6 cap or 7 cap, whereas local developers without all those compliances, you're struggling to sell at 9 cap, 10 cap. So
Yeah.
the value creation and enhancement by doing this can be far greater than using short-term measures. So I think that was a big turning point. I think where people started aspiring to build more efficient, greener, and more
Mm.
sustainable developments, which were acceptable to global capital and audiences.
True.